Namaskaram friends, we are starting with double taxation relief, also known as the DTAA, and this section is very small. In fact, it covers section 90, section 90A and section 91 of the syllabus. Major content is written in section 90 and 91, and out of three sections, if you ask me to select the most important section, then that's 91, unilateral relief. We will discuss about it. Majority of you already knows what is double taxation issue and how it happens, but still allow me to explain it once more so that we will have very clear picture in our mind that this is double taxation issue, and to cover double taxation issue or to provide relief on double taxation, provisions of section 90, 90 and 91 has been incorporated in income tax law. Now you must be knowing many Indian organizations are going global. Say for example, Tata's from India, they are starting a factory or they are starting a unit or they are earning income from the source in Canada. Okay, so they are having business in India, they are having business in Canada. Because it is a resident assessee, please understand, because it is a resident assessee, global income will be taxable in India, whether they are earning in India, whether they are earning in the foreign country. So you know that for a resident assessee, global income becomes taxable in India. So for an individual and HUF is concerned, for ordinary resident, global income becomes taxable in India. Now think from a Canada's perspective. So far as Canada is concerned, listen very carefully. This person, Indian resident person, is a non-resident in Canada, but a non-resident should be liable to pay tax in Canada as well, because the source of the income is located in Canada. So what is happening here? India is applying a residence rule of taxation, and Canada is applying source rule of taxation. Please understand, source rule of taxation. So one person is paying tax in Canada because source of income is located in Canada, and the same person on the same income is liable to pay tax in India because please understand, he is the resident of India according to the source rule. Now mark my words very much carefully here. The rules of computation of income in Canada and rules of computation of total income in India may not be the same. Meaning thereby, so far as salary chapter is concerned, in Canada you may not have standard deduction, but in India we are having 50,000 rupees standard deduction. So far as income from house property is concerned, in Canada you may not have a provision for deduction of municipal taxes or standard deduction, but India will have provisions of municipal taxes and standard deduction. What I am trying to say, though the income will be taxable, please understand, income is a tax in both the country, but the amount of income may vary. Please understand, it might happen that in Canada whole 10 lakh rupees income from house property is taxable, but in India only 7 lakh rupees is taxable after providing 30% standard relief. So this is one point you have to keep in mind very much carefully, because many of the times students get confused while solving the Q&A. They get confused that, oh, in Canada it was 10 lakh rupees, how come in India it has become 7 lakh rupees? It should be same income. It's not the same income. The same income is taxable but need not to be the same amount. Okay, so this is one point I wanted to make very clear. Now from Indian perspective, look at from Indian perspective. So India is approaching many global players that please start your organization in India. We want to double our GDP. India should become 5 trillion economy. That cannot happen without capital investment, and we are encouraging many global players to commence businesses in India, but they know that when they come to India, the problem of double taxation will happen. Sir, how? If foreigners are coming and setting up their businesses in India, you know that even NR is liable to pay tax in India. Even non-residents are liable to pay tax in India on an Indian income. On an income which is earned in India, obviously they are liable to pay tax in India. Now please understand one thing here, very important. When a non-resident is earning income from Indian source, government of India will take tax. But from a Canada or from Australia perspective, this non-resident is a resident in their country. Therefore, they will also take the tax by applying residence rule. So never imagine that only Indian government is applying residence rules and source rule. Even foreign countries are also facing the same problem. Therefore, globally, countries come together and they resolve this kind of issues. resolution of this issue happens either in United Nations model or through your OECD model. There are various models in the global taxation forums. So please understand, globe has a need of DTAA. It's not only India which needs DTAA. So one country will always try to meet another country, and mutually they will decide on terms of taxation, and then they will sign one agreement. That agreement is known as a tax treaty, alternatively also known as double taxation avoidance agreement. This is not a law. It's an agreement between the two nations, and because it is agreement between the two nations, it overrides the law of country A. It also overrides law of country B. So no matter what is written in your law, if a DTAA provides me the relief, I will get the relief, because the DTAA is created only with a view to give relief to the assessees who are facing double taxation consequences. So let's look at into the details paragraph of the chapter. Concept of double taxation relief. In a present era of cross-border transactions across the globe, the effect of taxation is one of the important consideration for any trade or investment decision. So before investing only, you have to look after the taxation structure of the nation. One of the most significant result of the globalization is the visible impact of countries' domestic tax policies on the economy of another country. Obviously, the moment you change your tax policies, it also impact globally, not only on domestic market. So any change in the domestic tax policies will have global impact from now onwards. This has led to the need of continuously assessing the tax regimes. Tax regimes means taxation laws of the various countries and bringing about necessary reforms. DTAA is one of the reform proposed by the global tax forums. Where the taxpayer is a resident in one country but has a source of income situated in another country, it gives rise to possible double taxation. This is in form of two basic rules that enable the country of residence as well as country where the source of income exists to impose the tax, namely residence rule of tax and source rule of tax. The source rule holds that income is to be taxed in the country in which it originates. So if income is originating in Canada, it is taxable in Canada. If it is originating in USA, it is taxable in USA. If it is originating in India, it is taxable in India. So originate irrespective whether the income accrues to the resident or a non-resident. Same law we have in India as well. You know that any income earned in India according to income tax, taxable in the hands of resident, ordinary resident, non-ordinary resident and even non-resident. Whereas the residence rules stipulate that power to tax should rest with the country in which the taxpayer resides. Okay. If both the rules apply simultaneously, one country is applying residence rule, another country is applying source rule, to the business entity, it will suffer to tax at both the ends. The cost of operating on international scale would become prohibitive and would deter the process of globalization. It is from this point of view that double taxation avoidance agreement become very significant. So they are just elaborating what is the importance of DTAA. DTAA lay down the allocation rules for taxation of income by source country and the residence country. So mutually they will decide either it will be taxed in the source country or it will be taxed in the residence country, and if taxed in the both country, then there will be some credit mechanism that we are going to learn. Such rules are laid for various categories of income, for example, interest, dividend, royalty, capital gain, etc., etc. Double taxation means taxing the same income twice in the hands of the assessee. A particular income may be taxed in India in the hands of the person because he is a resident in India. However, the same income may be taxed in the hands of the same entity in the source country because of the domestic law of that particular country where the income has been originated. This gives rise to double taxation, and it is universally accepted principle that the same income should not be subjected to tax twice. In order to take care of such situation, Income Tax Act 1961 has provided for double taxation relief, which is provided in section 90, 90A and section 91. Types of relief. Relief from the double taxation can be provided mainly in two ways. It can be bilateral and it can be unilateral. Bilateral means with word you can understand. Bi means two government can come forward and they will discuss. So this is happening in section 90 and 90A. The only difference between 90 and 90 is this is with the government and this is with the specified organization of that particular country. We will discuss that. And unilateral relief is given in section 91, which is the most important section from examination perspective. So what do you mean by bilateral? Under this method, government of two countries can enter into an agreement to provide relief against double taxation by mutually working on the basis on which the relief is to be granted. Please understand, it's not that India is having, right now India is having DTAA with more than 100 countries. That doesn't mean every country has the same DTA. See, when we two sit together, obviously we two will discuss, both countries will discuss their pros and cons, which income should be taxed in India, which income should not be taxed in India. So by mutual discussion that this agreement will be finalized. India has entered into agreement for relief against an avoidance of double taxation with more than 100 countries, which include Sri Lanka, Switzerland, Sweden, Denmark, Japan, Federal Republic of Germany, Greece, etc. With almost all major countries, we are having DTAA. Bilateral relief may be granted in either one of the following methods. So there are two methods, exemption method. So what do you mean by exemption method? If tax is levied by source country, residence country will exempt it. Okay. So if a particular income is taxed only in the source country, exempted in the residence country, this is the exemption rule. And then tax credit rule. So what do you mean tax credit method? Tax credit method means it will be taxed in the both country, but the country of residence, very important, country of residence will provide a relief in form of credit. If you have paid 2 lakh rupees tax in the foreign country and here you are about to pay another 10 lakh rupees, then 2 lakh rupees will be subtracted and you have to pay only net 8 lakh. So they will give you the relief like TDS relief, like TDS credit or MAT credit. This credit will be given to you. Okay. Income is taxable in the both countries in accordance with their respective tax laws. Read with double taxation agreement. The country of residence of a taxpayer, however, allows him. So which country will give you relief? Obviously your country. Okay. Credit for the tax charge thereon in the country of source. India follows credit method in majority of its DTAA, and for that India has also created rule 128 because there are a lot of complications arises. It's not that very simple example that 2 lakh rupees you have paid there, now 2 lakh rupees credit will be available here. Due to MAT and AMT, lot of recomputation has to happen. Because of that, we are having rule 128 in our syllabus. Unilateral relief. This method provides for the double taxation relief unilaterally. Unilaterally means at our own, not with consultation of the foreign country. Unilateral relief is provided by India to Indian residents. Okay, by a country of resident. Country to its resident for the taxes paid in other country, even where there is no DTA. Please understand, we don't have DTA, therefore unilateral relief. You have a DTA, then you have to follow the DTA. India grants unilateral relief through the credit method under section 91 to its residents for the taxes paid in the country with which India has not signed any DTAA. So this is very important section. We will discuss that section in detail. Thank you.